Hi everyone, this is Craig the Options Linebacker, and this is the weekend report for Sunday, November 1st. Where are the markets going from here? Well, we'll start with the S&P 500. This is my favorite chart for understanding the U.S. stock market. After 7 months of rally off of the bottom from this bear market from October 2007 till March 2009 so far, we've reached our first shot over the bow for the bulls here. Resistance came into play on this ascending trend line as well as the 20-period moving average. So our first negative month out of 8. So where are charts going to go from here? Well, we knew the charts aren't going to go from a lower low straight up to a higher high, even though it felt like that over the last couple of months that this thing was just going to go ballistic. At some point we're going to put in a lower high, but where? Well, this may be a good place for it to put in a pause. After about a 50% rally off the bottom, we almost got up to that 50% fib at 1120. So if it is going to dress down a little bit from here, where's it going to stop? Well, we don't know. We don't know whether this is going to create a lower low or a higher low. But if it does create a higher low, one place where it might stop would be somewhere in between S&P 934 up to 950 and create at least that higher low, which would be fairly significant because it would show a change in polarity from a higher high to a lower low to now a higher low. This would be significant because we went from a higher high to a lower low to a lower high, so that's the definition of a downtrend. But if we stick our boot in the door and all of a sudden put in a higher low, then it offers a potential change of polarity, especially if it can show a higher high above and beyond that. These are the way that market fractals work. You can't get ahead of yourself and wonder, are we going to do double dip recession, or are we going to head straight up from here? You have to take it one pivot at a time. What's significant about that 934 number? Well, it's the 38.2% retracement of this move here from the March bottom to the October top so far. And as we look over at the weekly chart, this is also bolstered by seeing this breakout pivot at around 950. So this is a typical 1, 2, 3 pivot as we come up here and create a higher high, and we drift back down and then break out through that level at 950. Now what very commonly happens is as we break out above a breakout level like that, it'll come down and retest it from above. And again, that level at 950 is also in confluence approximately with that 38.2% fib at 934. So again, that might be a place where we drift down and rest and find support at that level before the next wave starts working its way higher. Now, just because I have a target at potentially around 950 or 960 doesn't mean it's going to get there all at once. The Bollinger Bands are saying that, look, you've come a little too far, a little too fast right now, and the price is right down against the lower Bollinger Band. As we look at the Bollinger Bands, anytime the price has come down to that band or even popped outside of it, it's generally created a little bit of a rest for that move where it has to retrace, backfill a little bit before the trend can continue in that direction again. So right now it's come a long way in a short period of time, and it may need to show a bounce back up again before it can be shorted at a higher level. But that is assuming one thing. That's assuming that we are heading lower for now. If you look at the primary trend right now, it is still an uptrend. We're still making higher lows and higher highs. We have not violated that most recent higher low. We haven't created a lower low yet. So it's still a primary uptrend until that's violated and at the point where it creates lower lows and lower highs. Now, if it does violate that recent swing low and create a lower low, what are we going to look for this thing to bounce back up again? Well, one thing that we can look for is divergence. Divergence, as we make lower lows, creates higher lows on the MACD histogram, and of course we haven't had time to create that yet. But if we do create a lower low after a little bounce back up, we'll see that in the MACD histograms. It'll look like this, and it'll give us a leading signal that we can expect to see a bounce back after that signal. Now we're starting to see a lot of disparity in different types of markets. The big caps, as represented by the Dow, are still in primary uptrend with higher highs and higher lows, still holding that 50-day moving average very roughly within a couple of points of that. But we look at the Russell. The Russell has already put in a lower high and a lower low. That's a change in polarity. The Russell's actually already heading down from here. We have to respect the Russell as a leading indicator because it can often be the first one out of the gate on the way up. I mean, look at this, an 82% rally off the bottom. And it will also show the first on the way down, as it did back in October 2007 when it put in a lower high compared to all the other indices putting in higher highs. Something else to watch is Dow theory. As the Dow Industrials produce the product, the transports ship the product, and the transports have put in a double top and now a lower low. So right now the transports are non-confirming as far as Dow theory. This could be potential trouble. So watch the Baltic Dry Index for signals here. So what's going on with our positions for the months of November and December cycles? Well, our bear call spread, which was under some heat as little as a week or two ago, is now looking great. And we still have a lot of room to the downside on our put spread down here. And in fact, we have defensive butterflies in front of each trade. So a little less than 3 weeks to go now. We're in great shape with the price very close to the center of the Iron Condor for November. Now for our December positions, we're a little closer on the downside. Although we still have a good cushion to go before we have to get concerned with this trade. We're going to look for any kind of a bounce back up again in the price to secure a call spread back up here and neutralize the downside risk on the December Condor. Here's the P&L graph of our delta neutral Iron Condor for November. And you can see where the current price is very close to the center of the Condor. We have room to run in either direction, either to the downside or especially to the upside, since we've already hedged off the upside call spreads. So I think what we might end up seeing is a little bit more downside pressure and then a bounce back up into the center of the Condor, and by that time we may have our P&L nicely to the point where we can take early profits on this trade and not have to expose ourselves to any additional risk for the month. Now, as we've said since the summer, when in Rome, do as the Romans do. So if the charts are just going to go ballistically to the upside, then we're going to play swing strategies as well. And one of these is the 8 and 21 moving average cross. So anytime we see a cross of these two moving averages, we'll either play long or short on a bounce back to the 8 EMA. The charts have crossed, so we'll look to take in a short entry as the price comes up to retouch that 8 EMA. And here's our RSI2 strategy. We actually had just so close to a signal. We got down to 2.89 on the S&Ps, and we're looking for an RSI2 value of 2.0 or less, and right now it's showing 24. Any additional sell side pressure on this over the next day or two will create that signal. And here's the double 7 swing strategy. Now, because of the fact that the charts have been so jacked to the upside, it increases the risk of taking these additional signals long. So what we've been looking for before we start to employ more capital is a significant pullback, and this could be the one that we've been waiting on. So right now the only trade that I have in place is the XLF on this with a very small position. So probably I'll look to, if we do get a bounce and a 7-day high out of this, we'll probably just be able to break even or slight loss in this trade. But considering the number of winners that we've had on this strategy, no big deal. So that's it for this weekend, and thanks for watching. Make sure that you tune in next week for more in the markets. Really quick before you go, we just released a new product called Traders Fast Track, which is an inexpensive trading success program. If you go to the link in blue, we have a special offer where you can get our premium daily newsletter free for a whole month at optionslinebacker.com/fasttrack2. We also have some brand new free stuff for you. When you go to that Fast Track page, you can sign up for a free monthly newsletter dedicated to how successful traders operate, our Fast Track newsletter. You can also instantly download our brand new ebook for free, Technical Analysis for Options Traders, which shows you how a few simple yet powerful reads in the market can help improve your options trading profitability. Good trading. See you next week.